Hello and welcome to Switzer Investing TV. I'm Peter Switzer. Thanks for joining us. On tonight's program, I've got Paul Rickard. I promoted him to the top of the show because he's coming up with 4 beaten up stocks, which he thinks is really good value. Paul's not renowned for being a thrill seeker. And so when he's finding something that looks like good value, I think he should be promoted to the top of the show. Then we'll have Jun Bei Liu of 10 Cap. Tonight, she's going to be looking at this rotation out of the big cap stocks into the resources area. That's something I've been sweating on for some time. I'm really happy that she's seeing it. Plus, she's going to tell us the stock that she recently has been adding to her portfolio. And then we have Jordan Alessio. He's a GM of ABC Bullion Australia. And there's a time when the gold price is at record highs. And I want to know what drives gold, what could bring it undone, or what could send it higher. But he is an economist. He does understand gold, and his insights are very, very valuable. That's the show. Let's kick off now with Paul Rickard of the Switzer Report. Thanks for joining us, Paul.
Thank you, Peter.
Now, unusually, you actually got, well, I think it's a very interesting topic. You always deal with stuff that's important for people to listen to. But today you're looking at 4 beaten up stocks that you think might have some potential.
Yeah, well, I mean, I could think of lots of stocks I might want to sell in this market, but the
Yeah.
market is pretty stable and it's hard to, selling really hasn't been a brilliant strategy the last couple of months. So I'm looking for a bit more of the value, and I think the market eventually will have to go back to some of the value stocks out there.
Yeah.
Might take a little while, but sometimes you've got to be ahead of the pack and you've got to be patient. So here's some ideas about stocks that have really come off a long way, and I think there's more upside.
Well, it's interesting because in our previous guest, Jun Bei Liu, talked about the rotation she's seeing out of the big cap star performers, the banks, Wesfarmers, JB Hi-Fi, and whatever, into the resources stocks. But there are going to be other ones as well, aren't they, Paul? There'll be companies that, either for unusual company-specific reasons or interest rates, whatever it might be, a lot of those companies are going to be favoured because they do look beaten up. And so even when you can go looking and find something worth buying, is a very interesting trend. The Paul Rickard I want to buy trend, very important trend. I've never realised it, but I now see that
I had to buy sometimes.
and when he does, it's a good time to buy. So what do you got, mate?
So the first one, Treasury Wine Estates, which has been a perennial favourite of ours, Pete, for some time. It's really badly beaten up. It's now below $8.
Well, we've always liked it when its price is low.
We've always liked it when its price is low. It still has some great brands, still some, pressures in the US, particularly to do with some of the commercial wines that it's making. And the wine industry itself is struggling in terms of some headwinds in terms of consumers, or the younger people just don't drink wine like
Wrong with those young people.
some oldies do. But below $8, I think it's value. The analysts sort of agree. They've got about a 21% upside. It's already downgraded guidance for this coming earnings season. I think it might just, more chances of perhaps of a little bit of a positive surprise, but market's not looking for much, so low expectations, and that's a stock, I think, a bit of a portfolio stock. I might have to be patient, but worth considering.
I've never ever looked into this, Paul, but it'd be interesting to see if there are any significant Chinese shareholders in TWE, because they sell a lot into China.
They do.
The tariffs that stop them.
It's a big market for particularly the Penfolds label and some of the other labels that get tailored for the Chinese market. So yeah, it is a big market.
Okay, that's number 1. Number 2.
The second one is Ramsay, Pete. It's probably already had a bit of a rise. It's got Ramsay Healthcare, once an $80 stock. Now it's hovering below 40, got down to the low 30s. Again, really 2 problems for the Ramsay. First of all, the recovery from COVID in Australian hospitals has been really slow.
Yeah.
High cost, high patient staff ratios, problems in getting specialists and getting appointments done, and so the hospitals have struggled in terms of admissions, and that's a key part. And then secondly, it invested a lot of money offshore in markets like France, parts of Europe, the UK. Market sort of thinks most of its offshore investments have been duds a little bit because they're pretty regulated and unfriendly in terms of how private operators are considered. So that's why it's below It got down to the low 30s, now about $38. Analysts feel it's pretty fully priced, so they've marked down the valuations. This was a company at one stage had a $96 takeover offer for it.
And they said no.
And, well, I don't know whether it ever said no or the offshore part got on the way, but anyhow, $38, I think there's value there. Long-term holders, hang on.
Yep. Next one.
Third one won't come as any surprise. We keep talking about it most weeks. CSL, currently around about $242. Analysts think the upside is to 318. That's a 30% premium.
Let's pray they're right.
Yeah, at the moment, look, really stuck in sort of this limbo a little bit with, the sort of the Donald going on in terms of what he's going to do with pharmaceuticals. But, CSL probably won't be too badly impacted if he does do a tariff, but no one quite really knows because they collect a lot of the plasma in the US. They do some of the production offshore. How that works, I don't know. It really is. Its biggest market is the US, Pete. But it's sort of, I guess, why it hasn't been able to rally given the market's 5 or 10%. CSL's where it was 6 months ago, largely, or probably a little bit lower. And it really hasn't been able to go up when it's had that sort of influence. And so, and also in the US, the health sector's been one of the laggards in this run up. But I think CSL looks good value.
Yeah. And there is a feeling that health sector looks like good value, generally speaking, doesn't it? So, and CSL has been a star. You're right. The Trump question mark has been a pullback factor. But I tell you what, if the revelations are that he's not going to be as tough on this company, there will be a spike. And I guess you want to think about positioning yourself for that. Final one.
And the last one is Amcor. It's come off, it's rolling a little bit the last
week. It's called as a boring stock.
It is a boring stock because of what it does, packaging. A pretty boring market. I think it made a very good acquisition in the US. It's now getting the benefits of that. Market seemed to love it at $17 and then fall out of love again. I'm not sure why since the acquisition, but I think it's been a good acquisition what they've done. This is a acquisition driven on focus and driving cost out of their business. A little bit of revenue synergies. $14.70. Analysts think the upside is to $17.56. That's about a 20% upside.
Well, a boring company, isn't it?
It's a boring company. It pays a quarterly dividend, so you get 4 dividends. It's yielding about just over 4%, 4.5%.
No franking.
No franking, but it's a regular payer of income and it's pretty reliable and there's not a lot of volatility in its earnings. So look, again, a company that possibly could surprise on the upside. I think the market for some reason got a love with Brambles. Not quite sure why Brambles is where it is, but
so they kill it, Brambles. But it is more exciting than that.
It's a little more exciting than Amcor, not a lot. But there's another industrial. It's actually classified in the material sector because of what it does, which is packaging. But I think that's a good core portfolio stock. I think there's upside there, and a company to look at.
Seriously, Paul, listening to you has given me a really great idea for next week's Switzer Report story that you write on Mondays. You wouldn't use these words, but really, I'd love you to write about a portfolio of 10 stocks for the scaredy cat. Trump is Trump's scaring everybody, and like Amcor's a classic. When you put it in there, it could go up. 4% dividend. So if you could put together, say, 10, where you're at least getting a 4% or close to a 4% dividend plus franking, I reckon all the scaredy cats out there would actually see you as a pickup point. My only scaredy cat.
My only downside, Pete, with that is a lot of the so-called scaredy cat stocks, things like your Telstra, have already moved. And
you could do it.
I really like Telstra below $4, up near $5. I'm a bit 50-50 on it. But it's a classic scaredy cat stock because it's not going to be impacted by Trump.
Okay.
The yield is there. There's a little bit of earnings growth, and maybe there's some upside one day if it sort of hives off its carrier or its infrastructure, and there's a bit of upside. But that's a scaredy cat stock.
You think you can have a crack at that?
I'll have a think about that one.
Good stuff. That's Paul Rickard, promising to do a scaredy cat portfolio next week. Thanks for joining us, mate.
Thanks, Peter.
That's Paul Rickard of the Switzer Report. Go to switzerreport.com.au. And that's Paul Rickard of the Switzer Report. Let's go to Jun Bei Liu of 10 Cap, the fund manager, and see what she's buying right now. Thanks for joining us, Jun Bei Liu.
Thank you for having me, Peter.
Okay, let's start with the big picture first of all. What do you think are the main drivers of the market right now?
Look, the main driver of the market is that people are feeling a bit more confidence of what the next 6 months might look like. We've got interest rate cuts happening. We've got China growth not being too bad. And then the tariff. Obviously, there's a bit of uncertainty, but at least we feel like bit by bit we are getting a bit more clarity compared to what it was in April, where with just big numbers being thrown around. So net net, I think the market, it's investors become a bit more pragmatic. What we really seen beginning of this year, in the last couple of weeks, is that this big rotation movement out of some of the expensive company into the company kind of lags. These are the resources, for example, resource company, for example, has underperformed a lot in the last 12 months. Now we just see a bit of increasing in share price as the valuation became way too stretched and people were just selling some winners and putting to those names.
Well, I've been begging you to identify the rotation I wanted out of those big caps into the resources sector, because I've been pretty long BHP with myself and some of my clients. It seems to be happening now, doesn't it? The rotation into resources seems to be a noticeable trend, right?
Yeah, definitely. In the last couple of weeks, it's been very, very strong. In fact, it's from the late June we started seeing that movement.
Right. Okay. So what's been behind the shift in mentality towards the resources?
I think it just a few things. One is the valuation did become a bit too stretched, and a performance differential. So you compare to the CBA, everyone talk about CBA how well it's performed, and the BHP, the performance differential is just too large. So we're seeing a bit of reversal of that. And the two is that some of the China data hasn't been too bad, and there's a bit of policy support. So I think just that together, with the tariff not being as bad as what it was expecting, investor expected. So all that together, people were just seeing that people moving money sort of into the resources space.
Okay. Our one difference on the main drivers of the market is that I'm a little bit more unsettled about.
Sorry. Sorry.
Keep that
I couldn't
in.
hold it. I was trying to hold it.
Keep that in, Luke. All right. Okay. Now, one difference between you and me, and we don't often have many differences, but I'm just a little bit more unsettled about what Donald Trump can do to the market. And I do suspect anything he does will be more short term than long term. But you seem to have a very, brave, bravado face when it comes to what Trump can do to the stock market. Explain your thinking.
Yeah, look, our thinking is really, we don't know. Ultimately, we don't know what he could do, what he might do, and what it might, what the actual outcome, what's the number. So what we do is just work out what we do know and what we don't know, right? So, what we do know is that some company get impacted and others doesn't. And then you kind of work your way backwards. For the company it doesn't impact it, maybe there should be more parts of the portfolio can invest in this one. And if these company gets sold off, maybe these are good buying opportunity, which was what we did since the Liberation Day. But then when we talk about the tariff and all of that, for the company it does get impacted, which is not that many of them, taking out the resources sector, that's indirect impact from China. But for the very few company that gets impacted, it's a little bit harder to call because every second day people, well, for example, CSL, people saying, no, a 200% tariff on the pharmaceutical. However, they're already demonstrating they're investing $2 billion into America, but these buildings will take, the fractionation facility will take 4 or 5 years to really mature and properly done. So, there's a lot of uncertainty, and these companies, you kind of just need a much bigger discount. You want the very, low earnings expectations for you to be able to go into those companies. For example, Fisher and Paykel, they actually told all the analysts and told them to put the worst case scenario of tariff into the forecast. So this way you feel, okay, if share prices come off, but the earnings are already reflecting the worst case scenario, then maybe you can actually wait in and buy some of them. So that's kind of, you just need to separating out what you do know and what you don't know.
And in the bigger picture view, are you thinking the Trump and his tariff negotiations is more likely to be a short-term problem, but eventually they'll come out with some kind of reasonable solution and the market will like it, and so this becomes a buying opportunity for you?
Yeah, that definitely becomes a buying opportunity, especially now already seen it once. We've seen the playbook a few months ago, and if it happens again, it would be crazy not to buy the dip. So, ultimately, Trump wants to drive a stronger economy for America. He wants lower interest rate. He wants a stronger economic activity. So companies start investing in America. He doesn't really want to create all these disruption and nothing happens. So, my view is that it is absolutely will be a buying opportunity if it happens again.
Okay, you did mention CSL and you went into the analysis. One thing I picked up over the weekend was the 200% tariff. Even Trump has said, well, this could be in a year's or 2 years' time. Does that mean that maybe CSL is a buying opportunity for a tariff that might not even show up in 2 years' time?
Yeah, look, I think look, it is cheaper now. It represents a good buying opportunity, and especially today, in the newspaper, people are talking about them doing cost cutting to sort of get to the numbers because there is some softness across the, their flu division, vaccination and things. So, yeah, so I think the company it doesn't look cheap. It's in the low 20s multiple. Used to be higher, but it shouldn't go higher. It should be sort of it's in the right level. And if there is any relief from tariff, a share price will rally at least 10%. So, it looks very reasonable for the time being. I think the challenge for this company is that it has lost its luster for, as a structural grower because it hasn't really, its innovation hasn't really innovated, right? So, and then the V4 acquisition hasn't really worked for them. I think that's kind of the challenge of a growth stock, previous growth stock, now becoming a value stock. And that's why analysts always struggle in that changing over investor base.
Okay, now what about, I was surprised last week, copper cops apparently a 50% tariff, and a lot of the copper stocks, and BHP is long copper, BHP went up over that week. What's the thinking there,
Yeah.
Jun?
Again, it's coming back down to the relative valuation. So the copper stock has gone through the roof more recently because of this speculation of high tariff for the copper going to America. And but if you look at the BHP share price, it keeps going lower because big part of it is iron ore, and iron ore prices was under a bit of pressure more recently. So it wasn't trading like a copper stock. But if you look at some of the smaller copper names, share price more than doubles. So it really just the investors sort of looking at the copper. We had the news already out talking about potentially 50% tariff. And, it's almost like the buy the rumor, sell the fact. You take some profit in there and put into the lagar, which is BHP. Still got some profit, but still got some copper, but it's much cheaper.
Hard question. Is it too late for an investor to get into ProMedicus?
Oh, I never think it's too late. These are the times, where you have a bit of volatility, market, bit of rotation, taking some profit. I still think it's for the long term. It's never too late to buy this company. Recently, it just announced a whole string of new contracts. Some of the largest names, largest contracts for over multiple years, and they even got into the cardiology space, where that's a new vertical they're growing into. I just think this company's got so much strength in terms of the structural growth drivers behind it.
Okay, people are asking me about the zero share purchase plan. If you were just a normal investor rather than the stellar fund manager you are, would you take up the zero share purchase plan?
Yeah, look, I actually think the zero share purchase plan is very close to where the share price is at the moment. I haven't double checked today. I think it's very, very close. Look, I think it's a great deal, but it just if the share price is very close, you're not getting much discount. To be honest, if you want to buy shares, you can buy it online. In the marketplace.
Okay, finally, what is the stock that you've liked this week and have bought this week?
Stock I like this week and bought. I would say actually, yeah, it's a little bit early. So what we've started doing actually.
Oh, well, you can use last week if you like.
Yeah, that's right. So we actually had started buying this company a little while ago, maybe like 2 weeks ago. We started buying a bit more Iluka. It's partly driven by this value, sort of characteristics. The company's super cheap. The the mineral sands prices actually hasn't been too bad. China property is still tough, but look, it's stopped getting worse. Potentially a bit more stimulus, and then the rare earth is optionality. So we sort of saw that, and then we saw how well Lynas has performed. So that's one name that we bought a little bit more recently.
So Iluka, and you like Lynas as well?
I like Lynas as well, but the share price is really the lows.
It sure has. Jun Bei Liu, thanks for joining us. See you in a couple of weeks' time.
Thank you so much for having me.
And that was Jun Bei Liu of 10Cap. And now we catch up with Jordan Alessio, GM of ABC Bullion Australia. And I want to know why gold's price is so high and can it keep going up? Jordan, thanks for joining us.
My pleasure, Peter. Thank you for having me.
Now, just those people who aren't experts on gold, but lately have been very excited at what's happened to the price of gold, why don't you explain to the audience what are the main drivers of the gold price?
Sure, happy to. There are 3 or 4 key drivers. The first one is what is happening with interest rates. As a general rule, not always, but as a general rule, as rates are coming down, gold tends to become more attractive, especially if you then factor in the second driver, which is inflation. So in a world where rates are coming down, inflation's a little higher than expected. That tends to be very positive for gold. By contrast, in a world where rates are going a little bit higher or inflation is cooling, that can be more problematic. Another key driver for gold as well is what's happening with the stock market. So if you look at the last 50 plus years as a whole, gold has tended to be the best performing asset when stocks fall. So go back 2 or 3 months when Trump first started talking about tariffs. Obviously, the nature of them has been changing every day. But since that became a top of mind issue for markets and we saw a sell off in equities, gold again came to the fore there. So interest rates, inflation, stock market, the other one's the US dollar as well. And we've obviously been in a very, very soft period for the dollar. It's dropped about 10% year to date. And that's been another factor that's driven gold prices higher.
Okay. But as you know, I will reveal to my audience that for your sins, you were an economist, that there are conflicts even within those drivers of the gold price because, gold went up when inflation was spiking and interest rates were spiking as well. Was that because there was just so much uncertainty around inflation that gold was just seen as a safe place to put your money?
Absolutely right. And your broader point that those drivers of gold, they're not all uniform and they don't all have the same impact all at the same time. So you're absolutely right. In an environment where interest rates are going up, well, all other things being equal, you'd expect that maybe that's going to be bad for gold. But if inflation's going up by even more, or if the stock market's having a serious sell-off, gold's probably still going to do well. So obviously, if you think of all the various impacts or things that impact asset markets, none of them really act, completely alone. There's an interplay between them. And, if you look at obviously the last 6 months or calendar year to date, gold's done exceptionally well. It's up about 20% in Aussie dollar terms. Silver's gone up even further. And really that's a continuation of a bull market that really dates back to the turn of the century.
Yeah. Now, let's just also throw in a new driver, and we'll test it because this is my view from afar, and your view is from right inside the gold market. Donald Trump is great for gold investors, surely. This guy brings so much uncertainty to the table. He's got to be great for gold.
Yeah, I guess there's a question of, is he the driver of gold, or are the drivers of gold maybe just expressed through Trump? So go back to 2016 when he first won, his first race for the White House. Now, that was also the same year that Brexit occurred, and gold really took off well before Trump sort of got into the White House the first time. But yes, look, there's no question that, for want of a better term, he's kind of reimagining the world order, and that creates a bit of uncertainty, and that uncertainty is typically pretty positive for gold.
Okay. So obviously, because you work for ABC Bullion and I've known you for quite some time and you've been very positive on gold. And the story is that, you and I hatched together probably 10 years ago. I didn't say you were wrong, and I'm glad I didn't because you were right. Gold's gone in the right direction, but I put on screen a chart, and you know it, going back to 2004. And if you've got in 2004, it's up to about 2012, 13. You did pretty well, not like in recent times, but it was a decent gain. But from about 2013 to what, 17 or 18, it went sideways. And a lot of people, and you would have heard, a lot of people were whinging about the price of gold. And it's come good for those whingers. It's really done very well. But I guess the question that I have to ask, despite the fact that I'm friends with your employer, is the bottom line is, if Donald Trump starts playing a reasonable game on tariffs and interest rates head down and inflation is under control and the stock market goes up, would you kind of think that some of these great prices could come off the boil?
Definitely. In a world where, to your, I suppose, hypothesis, a world where stocks continue to rise and rise strongly, and a world where inflation remains under control, then certainly that you're going to get less of a safe haven bid for gold. And look, obviously, if you look at the last 6 months or 12 months, gold up 20% odd in the last 6 months, about 40 in the last 12. That's an abnormally high return. People shouldn't be expecting returns of 40% per annum out of their bullion holdings. The long run is closer to 10%ish, and it tends to do better in the environments like we're in now, where obviously there is a bit of uncertainty. So I think, as you said, we've probably been speaking on and off for the better part of a decade now, maybe even a little bit longer. And for the majority of that time, my view has been gold can very, very much complement a diversified portfolio in a very unique way, in terms of there aren't many other assets that have its liquidity and its diversification potential. I still think that holds true. But certainly, yes, people aren't going to get the same kind of return, every single year like they have in the last 12 months.
Okay, what does the current gold price look like compared to history? I've got my chart shows 20 odd years, but if we go back a long way, is this an unbelievably record high for gold?
If you take the sort of official inflation adjusted numbers, yes, we are back in pretty rarefied air for gold. Not so much for silver, and indeed that's one of the reasons why we see more people allocating a larger share of their precious metal portfolio to silver now. They see that it has the potential to outperform gold in the next few years. The point I'd make though regarding gold, if you look at it as a share of investable assets, as a share of client or investor portfolios, those numbers are still very modest compared to history. So clearly, it's been in a bull market for the better part of 20 years now. So I would say the easy money has probably been made in gold, but it still seems pretty clear that this bull market has some way to run.
Yeah. And it seems to me like it's just like my attitude to Bitcoin as it is with gold. For my clients, if they ask me, I say, well, the best time to buy it is when everyone doesn't like it. And we get it in a low price. But what was the reason why gold didn't go very far in that period that I was talking about, ranging from about 2012 to 2017, 18? What was the reason why it just didn't go anywhere?
Yeah, great question. I think the first thing is the starting point. So from 2000 to 2011 in US dollar terms, gold had gone from around 300 to at one point $1,900 an ounce. So it had sort of 6x'd in the 10 years before that period where it sold off started. So, it was starting at a high base is what I'm saying there. Secondly, equity markets really pushed higher in that period as well. So if you think, you go back to the GFC, the S&P 500 fell below 1,000 points. It spent a couple of years not doing too much. People were still very cautious about equities, but then it really started to take off. And the third one, and we talked about its importance earlier, is that inflation, despite all the QE and the stimulus from the Federal Reserve, inflation was pretty much dead from, really up until COVID hit. And so you had not much inflation, you had a roaring equity market, and you had stable, if not spectacular growth. All of those things contributed to that, 4 or 5 year window where gold had a bit of a correction and then treaded water.
Yeah. So it seems to me, Jordan, the best thing for your business and the price of gold is Donald Trump, because in a sense, his tariffs could excite inflation, right? Tick, good for gold. It could also be bad for the US dollar. So US dollar down, good for gold.
Well, yes, if the dollar falls, you'd expect that to be
Yeah.
better for gold.
He can at times scare the crap out of stock market players, right? Right. Okay. And what else we got? Any other? Yeah, and just the uncertainty he brings to the table makes people think, well, with gold, this is I've got something I can turn into liquidity. If he creates it, oh, that's right. He could create a recession, and recession people run the gold then, don't they?
They certainly do. Absolutely.
You should be sending him Christmas cards, mate. He's seriously great for gold.
We try to remain politically agnostic.
Yeah, I know.
I don't know about the Christmas cards, but look, obviously it has been a positive 12 months for bullion prices, no doubt.
We're going to know he's sending letters to everybody else. There's no reason why he shouldn't get a letter from you guys. Keep up the good work.
I would add as well that, he's been pretty vocal in his criticisms of the Fed chair, and he obviously wants interest rates much lower as well. So that's probably just another cherry on the cake at this point.
Yeah, okay. So now, for people who want to know more about gold, there's a special ABC Bullion conference coming out. Why don't you just give us a bit of details about that?
Yeah, sure. Thank you, Peter. Yeah, so on Tuesday, August the 19th, we're hosting a precious metals forum at the Ivy Ballroom in Sydney. We've hosted these, I think this will be the fourth one in about 10 years. So every 2 or 3 years, we tend to host one for our clients and also for people that just want to learn more about investing in bullion. They may not yet be clients of ours. So yeah, it's a Tuesday evening. It'll take a couple of hours. We'll throw in, some canapes and a glass of champagne, so it's nice and enjoyable. 3 or 4 keynote speakers on what's currently happening in the gold market, also what's happening in the Australian gold industry. So, the gold industry in Australia is a major employer, including indirect employees in the towns where gold mining is a big part of the local economy. The better part of 250,000 Australians are either employed directly or indirectly through the gold industry. So it's one of extreme importance to the national economy. And yeah, we're really looking forward to the evening and to welcoming as many people as we can there on the night.
Okay. Now I'm going to throw this question at you, and it was powered by my producer who, like everybody else, wants to get rich. He said, but a lot of people are probably thinking exactly what he's saying. So I'd just like to get your learned answer on this one. Given we've got 3 more years of Trump, is now the time to buy gold, even though it's at record highs? Now, it's not going to be advice. I made it clear. Whatever Jordan says, he wants to make, this is not advice. But let's imagine your brother or your mum and dad asked you exactly the same question, Jordan. What brilliant answer would you give?
The funny thing is that my brother and my mum did ask me, but again, only after the price had gone up. So, no, look, my comment would be the same as it's been for the last few years, and that is that I believe we're in a bull market, so I think people will make money provided they have a medium to long term time frame. I think gold can still play that very unique role in a portfolio. So I wouldn't be overdoing it as a share of a portfolio. Obviously, each and every person is different, but I think it deserves its place alongside equities, alongside fixed income, alongside cash. Every asset class has at least one drawback, and a nice balanced mix is probably the best way of getting through the next few years of the Trump presidency and all the other uncertainty that's going on in the world right now.
Okay. A producer says, who used to say that he's not suspiciously wealthy? Well, he might be, but I'm not as intrusive as he obviously is in this interview.
I'm sure you're looking after him, Peter.
Yeah, without a doubt. All right, Jordan, great to talk to you. And we might catch up with you guys just before the conference.
That'd be wonderful.
And that was Jordan Alessio of ABC Bullion. And that's the show for this week. Thanks for joining us. Don't forget, if you want more insights from other experts that we work with, go to the switzerreport.com.au website and please become a subscriber. That's the show. See you next week.